Today, we will be talking about something that's a vital part of closing a deal: financing. If you're thinking about buying your first property here in the Philippines, whether you are based locally or abroad, then this video is for you. There are four types of financing. We have cash, deferred cash, bank financing or pag-ibig financing, in-house financing. So let's begin with cash. Cash transactions are pretty straightforward. The buyer will usually make a reservation fee or give an earnest money, roughly around 10% of the total contract price for earnest money. Reservation is valid for 30 days, although with brokerage transactions, it can be longer depending on the agreement between the buyer and the seller. So for developers, it's 30 days. So within that time period, the seller cannot offer the property to another buyer. Once the conditions are fulfilled, then the buyer will fully pay the total contract price of the property one time. Cash transactions are the fastest to close because the cash is ready. So we just need to meet once with the buyer and the seller, sign the deed of sale, and then close the deal. And then we have deferred cash. This type of financing is offered by developers. The term is around 24 to 36 months to pay at no interest. So some developers may offer a longer term for deferred cash, but that's the standard. The advantage of a deferred cash scheme is that it has no interest. The disadvantage is that since it's payable over a short period of time, the monthly amortization is a sizable amount. So it's ideal for clients with significant monthly income who want to save on the interest rates from the bank. For example, a studio condo unit is at 3 million pesos and it's payable in 24 months. So you take the 3 million divided by 24 months, that's 125,000 per month. After 24 months, you are fully paid. And then bank financing or pag-ibig financing. So this is a type of financing wherein buyers get a loan from the bank or pag-ibig called a home loan to finance the purchase of a property. Bank financing is available to everybody who's eligible to get a loan, whether you are locally employed, an OFW, business owner, online worker, or freelancer. The bank will check your age, monthly income, credit score. The age limit of banks is at 65 years old, while with pag-ibig it's 70 years old. So a home loan is a type of financing that commercial banks offer to buyers who want to invest in a residential property via financing, usually either via the bank or pag-ibig. Take note that a home loan is only for residential property as banks don't accept other classifications as collateral. There are different kinds of home loans. I've discussed this already in a previous vlog, but I'll just do a quick run through. So we have home loan for a ready for occupancy house, condo, or lot. The bank will have their appraiser go to the property and appraise that property. The buyer will then need to submit the needed bank requirements so that the bank can screen the buyer. Both spouses will need to submit, if you're married, both spouses will need to submit their 2 valid IDs, marriage certificate, filled up home loan form, and appraisal fee. You need to pay the appraisal fee at the bank, which is usually around 5 to 10,000 depending on the bank. After the appraisal is done and once the buyer has been approved, the buyer can then loan 80% of the appraised value of the property if it's a house and lot, or if it's a house and lot, and 70% if it's a lot only or condo. So the difference then between the selling price and the loanable amount is the equity. Then we have home loan for a pre-selling purchase. So the same requirements are submitted, but there will no longer be an appraisal fee because developers and banks have a memorandum of undertaking wherein they will already set how much the buyer can loan for the houses available in that particular project in the developer's inventory. So the loanable amount for pre-selling properties are higher. It's up to 90% of the total contract price. And then the equity can also be paid in installment at no interest. Another type of loan is construction loan. The bank will appraise the lot since it will be part of the collateral, and additional requirements will then be submitted to the bank for the construction, such as bill of materials. Bank will then release 80% of the bill of materials and 70% of the lot's appraised value. Equity loan. This is a loan using a property you already own as collateral. So this is a lot faster since the title is already in your name. One reason why sellers prefer cash buyers is because for bank financing, the title needs to be transferred to the buyer's name before the loan is released. So with the pandemic going on and the government agencies on skeletal So now it takes about 6 months for title transfer. But with equity loan, there's no more need to wait for the title to be transferred because it's already under the borrower's name. So an equity loan, though, the downside is that it has a higher interest rate compared to other types of home loans. Because for the other home loans, they have between around 6 to 6.5% interest per annum, while for an equity loan, they have an interest of 8% per annum. The advantage of this loan, though, is that you can use this to buy properties that you can't otherwise have financed through home loans. Let's say you want to buy a farm or an industrial property via a home loan, so you can leverage on the properties that you already own to get an equity loan to finance the purchase. Okay, so let me quickly pull up a sample computation of a pre-selling project here in Cagayan de Oro Skyline Residences. So I will be pulling it up here on screen so you can check it out, and I will quickly run you through the entire computation sheet. So this is a computation for a lot, again, in Skyline Residences. It is located in Block 2, Lot 5. The area is 262 square meters. The price per square is 20,000 per square. So that's 5.2. And then they have a discount now, 10% discount, so less 524,000. That will bring you to a net selling price of 4.7 million, 4716 million. So the reservation fee, so as you can see in the computation, the down payment is 10% payable in 24 months. The balance is 90% payable through bank financing. So the reservation fee is 100,000 and your equity is 471,600. So you deduct the reservation fee from your equity, you will have a balance of 371,600 pesos. So you divide the balance, the 371K divided by 24 months, because the equity is payable in 24 months, it will give you an amount of 15,483 pesos. So that means your client will have a monthly equity of 15,483 per month for 24 months. So with the reservation, in order to reserve this property, aside from the other reservation requirements, the client will need to submit 100,000, a check for 100,000 for the reservation fee. And then after it's reserved, the client will also need to submit 24 post-dated checks to pay for the equity. If the client asks, can I just do fund transfer for the monthly equity? The answer is no. Most developers have either bank deduction, usually for developers that own banks, like SMDC or Ayala. If they own bank, then you can enroll your bank account, your BDO or Ayala bank account, and then they will just do auto deduction every month. But for the rest of the developers, they will ask for post-dated checks for equity payment. And then the loan amount, after the 24th month, your client will need to submit all the requirements at the bank and apply for a home loan. And the loan amount is 4.244 million. So if you open your mortgage calculator and then you input 4.244, 400. So 4.244. 400. Term is 15 years. Let's say the client is an OFW. Maximum term for OFW is usually 15 years. But if your client is locally employed, we can do 20 years or is just based in the Philippines. So let's say 15 years at 6.5% interest. So that will amount to 36,000 per month. So that will be your client's monthly amortization for the next 15 years after the equity is fully paid. So another thing you must know how to do is to compute the client's maximum loanable amount. So what I do is you should first download a mortgage calculator. It's a free app. I use it all the time. And for example, you open your mortgage calc. For example, your client's income is 150,000 per month. So you divide it by 3. 150K divided by 3, that's 50,000 per month. So this means your client's monthly amortization should not go beyond 50,000 per month. And then I just input the amount that will not go beyond 50. So I just do it randomly. Let's say 5.7. Yeah, so Or no, it's only 49 million, 5.8. No, it's 5.7. So at at 5.7 million loanable amount, payable in a term of 15 years at 6.5% interest, the monthly payment of your client would be at 49,000 per month. So it's close to the 50,000 per month monthly amortization that's allowable monthly amortization. So for a client with an income of 150,000, the maximum loanable amount for this client with a 150K income is 5.7. So it's 5.7 million. Now, if your client will ask, can I loan a bigger amount? Then yes, he can, but he or she will need to get a co-borrower to increase their income. In-house financing. This is sometimes offered by some developers as an option for buyers who are not approvable via bank financing. So one developer I know that offers this is Vista Land and Lifescapes, or more commonly known as Camellia Homes. However, since you are getting a loan from the developer to buy their property, in-house financing comes with a high interest rate at between 15 to 20% per annum. So it's a far cry compared to the 6.5% being offered by banks or Pag-ibig. So I don't really recommend this to my clients unless you intend to use it as bridge financing, meaning while you're still waiting for approval from Pag-ibig or the bank, you'll use in-house financing in the meantime. Unlike banks, which have a memorandum of undertaking with developers, wherein the buyer's loanable amount is already stated, Pag-ibig will wait for the developer to finish the project first, and then they will have the property appraised. So some buyers who prefer to go with Pag-ibig financing will go with in-house financing first while waiting for Pag-ibig's loan approval. So for example, Vista Land or Camellia, as they're more commonly known, they have a lower interest rate for their in-house financing, about 8% for the first 2 years. But after 2 years, they will revert back to their usual interest rate of 15 to 20% per annum. So the purpose of this is to just help buyers out while they're still waiting for Pag-ibig approval. They can avail of the in-house financing and then later on transfer to Pag-ibig. So again, the 4 types of financing are cash, deferred cash, bank financing, in-house financing. It's very important to understand the difference between all 4 so that you can choose the best financing option for you. Thank you for spending time with me today. If you want to know about the latest projects and new developments in Northern Mindanao and real estate how-to, send me an email so that I can add you to my mailing list. As always, I will see you in my next video.